Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts. Thanks for tuning in to this edition as we talk investing, finance, and retirement with Phil Putney. We got a fun show lined up this week. We're going to play the What If game. Actually, this is kind of an economic game that's played in a lot of economic classes. So we're going to jump in and get started. Phil, did you ever play this game when you were coming up and going to college and studying economics and all that kind of stuff?
No, I don't think so. I don't remember it, at least. I mean, okay. I may have, but missed that part of the class. It wasn't memorable.
Okay. All right. Well, so it could be a newer thing. I don't know. But basically, here's the setup in case you were curious. It's a situation where basically students are given a lot of variable scenarios, okay? Some of these might be a bit exaggeratory. They might not be really plausible. They might be. But their point is to get them thinking through the economic cycle of what that could look like if that was to happen on the other end. So I thought that would be kind of a fun game because really what you do, Phil, is you play a lot of the what if game with your clients because, people might hear that and say, well, no, I want some certainty. Well, that's what you're after when you work with an advisor, but you're what-ifing scenarios. What if this spouse passes away first? What if that spouse passes away first? What if taxes go up? What if, so on and so forth?
Yeah. There's a lot of variables that are at play that, we can't control, but we can prepare for what if, what does it look like if this happens and try to best make sure we've got plans in place to manage those variables.
Exactly. So I thought this would be a fun exercise, and we would play the college economic class game, What If? And again, some of these are kind of outlandish, but we'll talk through them and have some fun with them and see what's going on with some of these. So let's start with the first one here. Interest rates double over the next 5 years. Is that really a bad thing, I suppose? I mean, I guess it depends on what you're doing as an investor, right?
Right. Yeah, it kind of depends on where you're at. I mean, at first blush, it might sound like, oh, that's great. Finally, I'm going to earn some money in the bank, right?
If you're a saver, it's good.
Right. And there's a lot of pieces to that question of what if the interest rates double? From a saver standpoint, it's really good. I mean, that money in the bank is finally growing, but it has a lot of effects. I mean, number one is slow spending, and that's usually part of the reason the Fed uses that as that damper for inflation to help slow spending is to start to increase the interest rates, because now people start to think a little bit more about spending. I mean, if I'm earning, 0.0 nothing in the bank versus 5%, 10%, well, maybe I'll save some more.
Right.
So it's a little bit more encouraging to save, a little bit discouraging to spend, especially if you're borrowing for any kind of larger expenses, because now you're paying very high interest rates.
Right.
So you have to think twice about getting into that longer term debt, like a mortgage or, even vehicles, things of that nature, that all of a sudden interest rates have taken a significant increase on.
So if you're thinking about bonds, for example, as a safety, moving to bonds is more safety, as we hear sometimes for retirement, and interest rates are going up, not necessarily, because then now you've got a bond rate, right? Let's say someone's got a bond rate now at virtually nothing, 1%, let's call it.
Right.
And somebody's selling bond rates later on at 3% because the rates go up. Well, you're going to have a hard time off. You're not going to do so well with the 1%.
Right. Yeah. So for current investors in bonds, interest rates going up, it's going to be a disaster because their bonds are going to lose significant values. I mean, especially if it doubles. Right. But for investors that are wanting that safety, so to speak, of what a bond is typically thought to be, I mean, that's a good point because now you actually can earn something in that.
Right.
From a stock market standpoint, interest rates going up actually can have a detrimental effect on the stock market for several reasons. I mean, number one, if you think of from an investor, right now, if you've got money to invest and you're looking at, well, I can invest it in the bank and earn next to nothing, or same with bonds, a very little interest rate, and have that risk of rising interest rates. Investors, a lot of times, are willing to take a little bit more risk and maybe go into a dividend paying stock because it's going to at least pay a dividend, and typically at a higher rate, albeit more risk. But as interest rates rise, those investors that were kind of on the edge and only doing it for the dividend are going to jump out and go back to what they're comfortable with of, money in the bank or bonds or something that's more on that conservative realm, so to speak, or spectrum.
Right. Yep.
So that can have a negative effect on the stock market as investors leave, going back to safety.
And this is definitely a very plausible conversation to have, because it's certainly something that we could see that's very likely to happen. And again, a lot of these actually are fairly plausible.
They're very, very plausible. And I mean, as we're recording this, starting to see some of that effect. We're inflation, at least that part of it's starting to pick up. So,
right.
We're
going to get to that, yeah.
One of the tools the Fed has is starting to raise interest rates to help damper that if things continue. So.
Yep. Exactly. So let's move along because I got a few more of these to do.
Sure.
This one's interesting. The U.S. gets involved in a major war for the first time in decades.
Yep.
Now, some people might hear that and say, well, we've been involved with one for a long time. But I guess this would be a new one, right? That's where something we've obviously been continuing, and now we're kind of trying to get out finally.
Right.
All that kind of aside, if we were pulled into another conflict, again, from an economic standpoint, what does that look like?
I mean, I'm thinking more of a major war. I mean, we've been into, and I don't want to downplay the wars that we've been in, but it's not been a world war, something that has consumed, a lot of the resources and focus of the U.S.
True.
Like
Very true.
World War II or any of the major wars like that, where, I mean, there's pros and cons to it. A lot of time people, if you look back in that era, they think, well, it was an encouragement to the economy because, especially at that point, we were coming out of the Great Depression, and all of a sudden there's these jobs.
Yeah. Typically after the fact, you see a huge economic boom.
Right.
Obviously, through World War II, there was periods where it kind of shifted. Right. There was definitely hardships and tough times, and then you start to see this kind of boom because of factories having to build things and so on and so forth.
Yeah, but there's the downside of that too. Is now we're having to shift a lot of our resources and production to not what they were typically used for, but more towards war type items. I mean, we saw part of that or some of that actually going through the pandemic recently, where
True.
A lot of the manufacturers were being shifted and moved towards masks and ventilators and different things. So we saw a little glimpse of that, but
for a lot of folks, that's kind of an eye opener because that happened a lot during World War II, obviously.
Right. I mean,
most people aren't old enough to know that, right? Or remember that, obviously.
Yeah, auto manufacturing. I mean, they converted lines into doing tanks and all. Yeah, I mean, there was a lot of that, especially that manufacturing side of it. That was all shifted. But I mean, the downside of all that is, okay, who's going to pay for it? So you're borrowing, spending all this. And we've seen a lot of this same concept come into play through the pandemic. There's all this spending that's taken place that right now it's been borrowed money, and if you look back in those same timeframes after major wars. Taxes have taken an increase because now they've got to pay that back.
They've got to pay it back.
They've got to generate revenue to pay for all the cost of what it was that they had went through with a war. So.
Yeah, and that certainly can be, it's plausible on the horizon. And so again, thinking through this from these economic classes, these students are kind of charged with doing these kind of things. And what might that look like? Well, what might that look like is also for planning for, retirements or retirements not happening because of things of that nature. So, these are all, it's kind of just an interesting scenario to think through. Let's bring it into one that's very, very topical. That one might not be as topical right now, but let's talk about one here at home that's definitely on the horizon all the time. And that's the college education becomes free conversation. First of all, I think free is the wrong word. I think affordable. I mean, I think affordable is a conversation worth having, getting some of these schools under control. But for the sake of this what if scenario, what if college education became free? I mean, first of all, you're devaluing, I think, if everyone has a degree, what does the job situation look like? And that's part of that economic cycle.
Yeah, I mean, there are, again, a lot of aspects to that question. And you brought up one of them is just the value of an education. I mean, today, if you want that education, it's going to cost you something, or your parents or somebody's going to pay. And it's getting to be a extremely hefty cost just for even a basic 4-year degree, not even going into medical or legal or, some career that you can expect typically to have, substantial, educational bills. So I mean, all of a sudden, if this becomes free, you're devaluing it, which is not a good thing, and you're getting people going into education or college because it's free, and maybe that's not a good fit because at the end of the day, I think I mean, even today, I think we've lost sight of some of that. That
Yeah, the effort's not
college
great.
isn't for everyone.
Yeah.
Right.
Yeah,
I
you're
mean,
not trying as hard as maybe you might if you're working for it.
oh, absolutely. Yeah. I mean, there's that side of it too, where, if you don't have any skin in the game, so to speak, in this from a cost standpoint, it doesn't cost me anything. I can become a professional student, right? I mean,
Right.
what does that look
Right.
like? Is there going
Right.
to be a limit? Okay, it's free for, and then we're back to the other side of spending. Okay, that's great. But the reality is nothing's free.
Yeah.
I mean, if you look at some of the countries where that is free, what does the tax side of that country look like?
Right. And that's what I was going to say. That brings into the conversation of getting it paid for, because nothing is free. So
It's not free. Somebody's paying for it.
Right. From an economic standpoint, what are we talking here? So we're talking increased taxes,
Right.
revenue generation in different ways. And we're seeing a lot of that, Phil, in some of the different things that they're starting to target. You and I have talked about this over the last little bit. There
Right.
seems to be a bit of a target on the back of generational wealth growing. Some of
Yep.
the little rules that are happening, or potentially happening, I should say,
Yep.
may make that harder for you to leave wealth to your heirs.
Yep,
And that's
absolutely.
target.
Yeah, I mean they're already starting to look at, how are they going to pay for some of these big expenses like we'd mentioned, through the pandemic. And I mean, even before that, we've been spending at a deficit as a country for years.
Mhm.
And this debt has grown. So there's has to be this shift where there's revenue raised to start paying down the debt. And we didn't even touch on that in the interest discussion, but that's a whole nother part of the interest is if you think
Right.
about how much debt we as a country have, what happens if interest rates double to us as a country?
Great point. Yeah, because
I mean, we're all of a sudden paying how much of our revenue to interest on this
Yeah.
debt.
yeah.
So,
Yeah, we get frustrated with paying our the interest rate on our mortgage. Let's say, can you imagine
Right.
even a low interest rate on 29 trillion?
yeah, exactly. Where's that
How much is going to
90-day
principal?
sales cash type of deal or whatever?
Yeah. How much is going to principal in that one, right? Okay, so let's do another one here, kind of keeping that theme. This
Sure.
was definitely on the potential horizon as well. Another big economic downturn. We've been riding. I mean, other than the pullback in the pandemic, it came back pretty good. You could really make the argument that we haven't had a significant economic downturn since 08, 09. Again, you could make the argument all day long about loss of jobs, but the pandemic is kind of a one-off there. So
Right.
the housing market is pretty out of control again, right? Prices
Right.
are through
Yep.
the roof. There's we're seeing interest rates going, or excuse me, we're seeing inflation going up. We're seeing all
Yep.
these things happen. There could be another big bubble waiting to pop, and we could be 08, 09 all over again.
Yeah, I mean, there's a lot of indicators that we're on the edge of something like that. I mean, housing, like you had mentioned, there's a lot of if you do that, history doesn't necessarily repeat itself, but it rhymes. If you
Right.
kind of go back and look, we're rhyming a lot with some of the past economic volatility we've seen. Right?
Yeah.
I mean, housing's at a peak.
Yeah.
Crazy things going on there with mortgages and
Yeah.
so I mean, at some point, yeah, they're and that's just what economies and markets do. I mean, they ebb and flow. They're meant to go through these cycles, and we keep bumping against these peaks and breaking through new barriers in the market. But at some point, reality gets set back in, and markets are going to correct and come back to that average to the mean, so to speak.
Mhm.
If you look at the average expectation in a market isn't 12, 13, 14%. On average, 8, 9% over long periods of time. So how long have we been averaging way above that? That
Right.
means you're going to give some of that back at some point to bring it back down to that reversion to the mean, so to speak.
Yeah.
So,
And there's so many of these, when we're talking about some sort of a bigger economic crisis, there's so many little indicators that are there.
yep,
It's really important to kind of be thinking these things through, because when we've talked about it before on the show, if you were 45 in 08, 09 and you lost 50%, you weren't happy. It ticked you off pretty good.
right.
But you knew you still had 15, 20 years to retirement,
Right.
65, let's say.
Yep.
Well, fast forward now, almost, what are we at? 13 years, somewhere
13 years in, yeah, you're
Yeah.
yep. You're
Yeah.
probably at retirement or getting close to it. It's looking a lot closer. So,
Yeah. Now you're not wouldn't be so happy about a 40 to 50% downturn.
right.
So,
And we've talked about that a lot in the podcast over time, but you have to have a strategy to handle volatility.
Yeah.
and it's one of those pros and cons. Risk leads to naturally volatility, and that's where you potentially have the higher returns.
Yeah.
So
Right.
what
Right.
you need for long term with inflation, but yet you've got to make sure it's positioned in such a way that it doesn't harm you.
Yeah.
So back to our discussion, we've had a lot on bucketizing. That's how we handle it, is we make sure we've got money positioned in no risk or low volatility type investments.
Right.
That's where we're spending from. So as that happens, we're not as concerned from that standpoint. We don't get into what we call sequence of returns, spending money when it's down.
Right. Right.
The later bucket can have a little bit of volatility and ride through. You've got time to ride through that up and down. So you have to have a strategy that is going to hedge that. The same thing that worked over the last 12, 13 years, 14 years isn't going to continue to work long term if you're in retirement spending from it. So,
well, in retirement spending, we're talking inflation. This really kind of wasn't on the list, and it kind of is. I'm just going to lump a couple of things together real fast, and we'll move to some of the other ones. But just inflation in general, right? So you're talking possible premiums on things. So again, hypothetical. You eliminate or start to really eliminate gasoline cars, which they want to do. Go to electric. There's a whole manufacturing issue there. Then the price of oil doubles because they want to pay a premium for people. If you're going to drive a gas car, you're going to pay for it.
You're going to get penalized.
You're going to get penalized, basically. Even with steak, right? There's conversations about maybe making a beef tax, right? An additional beef tax in order to kind of push the narrative of getting, climate control and reducing the amount of red meat consumption. Whatever the political slant might be, all of that still reads as inflation to what it costs you to live, right?
Right.
So if you're in retirement and you say, hey, I really want my steak, or I really want to drive my classic car that I have in my garage that I worked so hard for and rebuilt in retirement,
right,
you may be paying additional dollars for it.
Yeah, and inflation is one of those, almost a hidden tax, so to speak, that you don't think of, and it unfortunately sneaks up on you. It happens over time, and it's amazing in planning. If you just run a pretty mild inflation, we use the last 20-year historical has been 2.56, although I'm sure that's going to be going up now as the inflation we've started to see.
Right, 4.
But even in that, you run that, call it 2.6% inflation over a 20-year retirement, that almost doubles what your expenditures were.
Right. Yep.
Over time. So it's amazing if you really sit down and run the numbers on inflation and see what happens in your plan. So you have to have some planning, first of all, to even understand inflation and make sure you're keeping up with it at some point. But then beyond that, that longer term potential for higher inflation, you've got to make sure you've got that covered as well. So.
Well, and again, whether it's a tax or whether it's just the cost of, hey, you know what, you want to use gas. Gas is now, for $6 a gallon because we're trying to get people to not, drive a gas.
Right.
Whatever the case is, it's still something that you would have to think through, especially if you're just getting close to retirement. Like I'm 50, so somewhere in the next 10 years could see a lot of really interesting things happen that could really cause me some issues and my wife some issues and folks my age some retirement issues in another 12, 15 years. The idea of the whole what if game, the whole what if scenario for college students is to think things through so that they can start to think about economic ramifications. Well, again, Phil, that's what you're supposed to do. So you use a lot of different software, you go through different scenarios because everything you do is really what ifing this might happen to my client so that I can have them as prepared as possible.
Exactly. Yeah. And if you haven't done that, then I encourage you to work with an advisor to be able to run some numbers to say, okay, what happens if? What does it look like if interest rates rise? How does that affect my current portfolio? And if it's dramatically affecting it, maybe you better make some adjustments.
Yeah.
With all these different discussions we have, taxes, I mean, if they go up, and this is a big part of our discussion all the time with clients, is making sure that your overall tax balance in the portfolio, diversification is there so you don't have too much money heavily weighted in that tax deferred retirement account, that taxes aren't due until the money comes out at whatever the rate is then. So.
Yep. Yeah. And so sitting down with an advisor, running a Social Security what if, running a taxes what if, an inflation what if, just your income, what ifs, all pensions, all that kind of stuff. Again, loss of a spouse at a certain time, so on and so forth. all of that really is what an advisor can, bring to the table in working with somebody. So again, as always, folks, if you got some questions, you need some help, reach out to Phil and have a conversation with him. Get on the calendar by calling 248-888-7530. That's 248-888-7530. You can also subscribe to the show on Apple, Google, Spotify. Find all that stuff at philstaxhacks.com. That's philstaxhacks.com. Phil, thanks for playing the What If game with me and hanging out. And we're taking
good. It was great.
Yeah, right before Memorial Weekend. So
yeah,
hopefully, what if my burgers are good and the rain?
That's right. Let's have a better, what if the weather holds out? That's the big what if in Michigan always. So
yeah, that's going to be the case for us here as well too. So what if the weather holds out? What am I doing? Hopefully, sitting in my pool.
There you go. Well, I tell you, this week has been hot enough. I think people are starting to consider opening it a little early, because usually Memorial Day is kind of the opening day for pools. At least it was when we had a pool. So.
Yeah, it's the unofficial kickoff to summer for everybody. It might not be actually summer, but it's typically the unofficial. So enjoy your holiday. Everybody have a great, safe, sane Memorial Day weekend. We'll be back with more here on Phil's Tax Hacks and other retirement facts with CPA personal financial specialist Phil Putney. We'll see you next time.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.